The Canadian dollar rises, it falls, and every time it moves a few cents, someone on the news says it's a crisis or a miracle. But what actually makes the loonie jump around? Why does it sometimes strengthen even when the economy is weak, and fall when things seem stable? And most importantly, what does the value of the Canadian dollar mean for your wallet, your job, and your cost of living? Today, we break down exactly why the Canadian dollar moves in simple terms.
Music licensing reimagined.
The value of the Canadian dollar is determined the same way markets price anything: supply and demand. If more people and institutions want Canadian dollars, its value will go up. If fewer people want it, then the value goes down. But why does this demand change? 4 forces drive most of the movement: interest rates, oil prices, trade balances, and foreign investment, and global risk sentiment. Today we're going to dig deeper into each one of these and learn why and how it affects our Canadian dollar. Currencies love higher interest rates. If the Bank of Canada raises interest rates, the Canadian government suddenly pays more interest for its bonds. These higher rates cause investors to want these higher returns and buy the bonds. However, if foreign investors want to buy these bonds, they first need to buy Canadian dollars, which increases demand in the currency, causing the exchange rate to increase. So, higher interest rates equals more demand for the Canadian dollar and a stronger currency. Inversely, lower interest rates equal less demand for the Canadian dollar, which equals a weaker currency. But how does the Bank of Canada determine when or how to adjust rates? The BOC has 4 main areas of responsibility: monetary policy, financial system stability, currency issuance, and funds management. However, they decide when to adjust interest rates primarily to achieve its 2% inflation target within a range of 1 to 3%. To do this, they monitor the trend of the Consumer Price Index, also known as the CPI. This is a basket of around 700 everyday goods and services. These include food items, shelter, transportation, household items, clothing, health, education, and recreational products like alcohol, tobacco, and cannabis. They will also monitor other categories to assess the strength of the economy. Things like the labor market, like unemployment rate, job creation numbers, and wage growth. They'll take this along with macroeconomic trends to determine the health of the Canadian economy. If the economy is deemed too strong and growing rapidly, they may increase rates to slow this growth to prevent an increase in inflation. Inversely, if the economy is deemed weak or in a recession, they will lower rates in an effort to increase borrowing to try to stimulate the economy. So if rates are higher, more money will flow into the country, causing demand for the dollar to increase, while lower rates cause an outflow of Canadian dollars. Canada is one of the world's largest exporters of oil. We rank 4th in the world and account for roughly 8.5% of all oil exported around the globe. All this oil is sold in US dollars. For each barrel of oil sold, Canadian oil producers receive a USD. These companies in turn, to cover their expenses, pay employees, and taxes, need to convert these US dollars into Canadian dollars, thus again increasing demand for the CAD and strengthening it. When oil prices increase, there's also an increase in USD that needs to be converted further, increasing the CAD, and again when oil falls, so does the inflow of USD, causing a weakening of the Canadian dollar. This is why markets sometimes call the CAD a petrocurrency. This petrocurrency also causes an increase in confidence in the Canadian economy when oil prices rise, causing foreign investors to put more money in Canada, again causing high demand for the CAD. This trend has weakened in recent years, particularly since 2010 due to a lack of investment in Canadian oil due to stricter government regulations and companies looking elsewhere to develop oil activity. The more recent government seems to have a desire to be soft in the Canadian oil sector, so time will tell how this affects the Canadian economy and its currency. Trade flows and foreign investment are critical drivers of the value of the Canadian dollar. They directly impact the demand for the currency, and with 65% of Canada's GDP relying on trade, this makes the country particularly sensitive to these factors. Trade flows are the buying and selling of both goods and services between Canada and other nations. This is measured by the balance of trade. When we export goods and services to other nations, these foreign buyers drive demand for the Canadian dollar as they need it to pay for everything. In the third quarter of 2025, Canada was running a trade deficit of roughly $9.7 billion. This was a great improvement over the second quarter, which was a record high deficit of $21.2 billion. We do continue to run a trade surplus with the United States, which is one more reason why they are such an important partner. This was severely impacted in 2025 when the US implemented several major broad-based and sectoral tariffs on imports. Although Americans do pay for these tariffs in the end, it does affect how competitive the pricing is for our goods and services. These negatively impacted almost all forms of exports to the US. This can be seen quarterly, as in Q1 of 2025, Canada had a trade surplus with the US of $31.7 billion. This was followed up by a sharp decline in Q2, where it was only $10.9 billion. Foreign investment is another impact on the demand for Canadian dollars, driving up the currency. When foreign entities invest directly into Canadian businesses, real estate, or build new facilities, they must first convert their money into CAD to make these investments. In Q3 of 2025, foreign direct investment in Canada was $18.2 billion. This was a decrease from Q2 with $21.9 billion. This, unfortunately, however, is offset by Canadians investing outside of Canada, with a total outflow of $25.1 billion in Q3 of this year. The final factor we'll discuss today is the global risk sentiment. During a period of uncertainty or economic turmoil, investors will move their money into what is known as safe haven assets. These are assets like the US dollar, gold, and Bitcoin. And when the world gets scared, money often flows out of currencies like the Canadian dollar into these assets. This means that bad global news equals the CAD falling, and global confidence will mean a stronger Canadian dollar, even if nothing has changed in Canada.
Music licensing reimagined.
So why does this matter to you? The value of the loonie affects everything in your financial life. The first is imports and the prices of everyday goods. Canada imports most consumer goods like electronics, clothing, and cars. When the Canadian dollar is weaker, this means imports are more expensive for us and causes prices to rise. When the dollar is strong, this makes these imports cheaper, making your dollars go further. If you've ever gone to the US or Europe during a weak CAD cycle, you know the pain. When the dollar is worth less in other nations, it makes travel that much more expensive. A weaker dollar helps increase stability in exports and manufacturing jobs. These sectors benefit from lower input costs due to the cheaper imports. But a strong dollar helps import-heavy industries and consumers. Canadians who invest abroad often benefit from a weak dollar. This is due to when the revenues of foreign investments are converted into Canadian dollars. Your US investments rise or fall partly based on the movement of the Canadian dollar. Sometimes the loonie seems to jump even without any big news. There's three common causes of this. The first is speculation, traders betting on future changes. Just algorithmic trading, machines reacting to tiny signals in the market, and comparisons to other currencies. The CAD may fall not because Canada is weak, but because the US dollar is strong. Currencies are relative. Even if Canada doesn't change, the exchange rate can. Looking ahead, where is the loonie going? Economists expect the loonie to remain in a middle range unless something big changes, like a major move in oil prices or a large interest rate gap between Canada and the US. The question for the next decade is, will Canada remain tied to commodities like oil, or will tech, AI, and green energy change the long-term relationship? So next time you hear the Canadian dollar rose 2 cents, remember currencies move for a reason. Oil prices, interest rates, trade flows, risk sentiment. They all shape the value of our money and how far your dollar actually goes. If you enjoyed this breakdown, hit subscribe and let me know what you want to discuss next.